The Maginot Line has fallen. It is over. The era of price suppression, the era of the bank smash, and the era of cheap silver have officially ended. If you are looking at the chart right now, you are seeing something that defies 40 years of market manipulation. Yesterday, the commercial banks launched an all-out assault on the $84 level. They threw billions of dollars in paper contracts at the market. They triggered the algorithms. They painted the tape red. In any other year, in 2011 and 2020, this would have worked. The price would have collapsed to $70. The retail investors would have panicked. The stops would have been triggered. But today, the smoke cleared and the price is still standing at $84. This is the commercial signal failure we have been warning you about. The Maginot Line of the paper shorts has been overrun. When a manipulated market fails to crash on bad news or massive selling pressure, it means the manipulator has lost their ammunition. The banks fired their biggest cannon and the market simply absorbed the blow and asked for more. The silence from the trading desks in London and New York is deafening. They know what this means. It means the Fed put is gone. It means the JP Morgan put is dead. The shorts are now trapped in a burning room with no exit. They are naked short against a physical reality that is devouring inventory at a pace we have never seen before. Holding $84 is not just a technical victory, it is a regime change. It confirms that the price is no longer set by the paper derivative. It is being set by the physical shortage. The floor under the market is not speculation, it is concrete industrial demand. We are watching the psychological break of the cartel. They tried to break you, but they broke themselves. The paper shorts are currently staring at billions in mark-to-market losses. They have two choices: double down and risk total insolvency, or capitulate and cover. And judging by the price action this morning, the capitulation has begun. The anatomy of the trap. To understand why holding $84 is the death knell for the shorts, you have to look at the gamma wall. For months, the banks sold call options with strike prices at $80, $82, and $84. They collected the premiums, betting the price would never get here. When we crossed $84, those options went in the money. This forces the market makers to hedge. They are contractually obligated to deliver silver they do not have. Usually, they smash the price to get out of this trap. They create a liquidity flush to scare you into selling, so the price drops back below the strike price. But because $84 held, the gamma trap has snapped shut. The market makers are now forced to become buyers. They have to buy futures contracts to hedge their exposure. This creates a feedback loop. The more they buy, the higher the price goes. The higher the price goes, the more they have to buy. This is the engine of a melt-up. We are seeing the open interest explode, but the price isn't dropping. This means new shorts are entering the market, trying to defend the level, and they are being swallowed alive by new longs. The shorts are adding fuel to the fire. They are building a pile of dry powder that is going to detonate the moment we cross 85.50. The algorithm is confused. It is programmed to sell strength, but the strength is relentless. The robot is fighting physics, and physics is winning. The holding of $84 proves that the selling pressure is artificial, but the buying pressure is structural. One is finite, the other is infinite. Shanghai disconnect. Why did the price hold? Who stood in front of the bank steamroller and refused to move? It wasn't Reddit traders. It wasn't the Hunt brothers. It was Shanghai. We have been tracking the arbitrage gap for weeks. Right now, silver in China is trading at a premium that converts to roughly $89 or $90. When New York tried to smash the price to $84, they effectively put silver on sale for the Chinese industrial complex. The Shanghai put is the mechanism that broke the shorts. Every time the price dips in the West, the East buys. They use the arbitrage to drain the COMEX. The banks in New York are trying to play a game of paper poker, while the banks in Shanghai are playing resource monopoly. We are seeing evidence that the load-out queues at the vaults are lengthening. The metal is moving from registered, available for delivery, to eligible, private storage, or leaving the system entirely. The flow is one way, west to east. The $84 hold confirms that the Chinese bid is relentless. They are not speculating on a chart. They are securing strategic reserves for solar panels, EVs, and military applications. They know the West is running out. They know the mines are tapping out. So they are draining the liquidity while the price is still suppressed. The shorts in New York are fighting a ghost. They think they are fighting retail speculators, but they are actually fighting the sovereign currency of a superpower. That is a fight they cannot win. The industrial floor. Let's pivot to the real world. Forget the charts for a second. Look at the factory floor. The reason $84 held is because below that price, the physical supply chain simply stops functioning. The miners are starting to withhold supply. Why would a CEO sell his silver at $84 today when he sees the inventory data? He knows the banks are trapped. He knows the price has to go higher to incentivize new production. So the miners are sitting on their hands. This is a supply strike. On the other side, you have the industrial vacuum. Samsung, Tesla, and the solar giants, they are panic buying. They have shifted from just-in-time inventory to just-in-case. They saw the volatility yesterday. They saw the attempted smash, and it terrified them. It terrified them because it showed them that the market is unstable. Corporate procurement officers hate instability. They would rather pay $90 for a guaranteed delivery than gamble on $84 with a risk of non-delivery. So they are placing market on close orders. They are sweeping the floor. This industrial demand is price inelastic. The cost of silver is a tiny fraction of the cost of an electric car or a solar farm. They don't care if silver is 84 miles or 100. They care if the assembly line stops. This creates a concrete floor under the price that the paper shorts cannot break through. The unobtainium phase. We are now entering the unobtainium phase. Since $84 held, the disconnect between the paper price and the physical price is about to widen into a chasm. The banks might try to keep the spot price on the screen at $85 or $86. But try to buy a monster box of Eagles, try to buy a 100-ounce bar. You will see one of two things. Out of stock. Premiums that make your eyes water. Dealers are terrified of replacement cost. If they sell to you at $84 and the price gaps to $90 over the weekend, they lose money. So they widen the spread. They protect themselves. This confirms the liquidity crisis. It isn't just paper liquidity that is missing. It is physical liquidity. The metal is in hiding. The holders are not selling. The weak hands were washed out at $70. The people holding silver at $84 are the diamond hands. They are the believers. They are not selling for fiat currency. They are holding for the collapse of fiat currency. We are approaching a state where the spot price becomes a ghost number. It is a reference point that nobody can actually trade at. If the COMEX declares force majeure and settles contracts in cash, they will give you $84 fiat dollars. But the real price, the street price, will be $120. This is the paper trap. The only way to avoid it is to hold the metal yourself. If you don't hold it, you don't own it. And right now, ownership is everything. The miner pivot. So the physical market is tightening. The paper shorts are broken. Where does the smart money go next? It rotates into the miners. For 10 years, the mining sector has been a graveyard, but holding $84 changes the math of every silver mine on the planet. At $25 silver, a mine was surviving. At $84 silver, a mine is a cash flow machine. Margins have exploded by 500% or 600%. But the stock prices haven't moved yet. Wall Street is asleep. They are still looking at trailing 12-month earnings. They haven't priced in the new reality. This is the arbitrage opportunity of a lifetime. We are seeing the early signs of a sector rotation. Capital is leaving the overvalued tech stocks and looking for real assets. When the Q1 earnings reports come out, and these miners announce record dividends and stock buybacks, the herd will stampede into this tiny sector. But you must be selective. You want the unhedged miners, the ones who didn't sell their future production at 30, and you want the ones with leverage to the spot price. And you want safe jurisdictions. You don't want to mine in a country that is going to nationalize the profits. You want Canada, USA, Australia. The miner pivot is the second stage of the rocket. The physical squeeze launched us. The mining mania will carry us to the stratosphere. The empire strikes back. The regulatory war. Do not think for a second that the banks will go quietly into the night. They have lost the market war, so they will start the regulatory war. We expect the empire to strike back within days. Watch for. Margin hikes. The CME Group will likely raise margin requirements to punish the longs. They will try to make it too expensive for you to hold a contract. Putzier, media propaganda. They will roll out the experts to call silver a bubble. They will say it is cornered by Reddit speculators. They will threaten windfall taxes. Do not listen. These are the tactics of a losing side. Regulations cannot print silver. Margin hikes cannot create silver. Taxes cannot manufacture silver. All they can do is create volatility. If they smash the price to $80 tomorrow on a regulatory headline, treat it as a gift. It is a discount coupon for a product that is running out. The fundamental reality, the shortage, cannot be fixed by a bureaucrat with a pen. It can only be fixed by higher prices, much higher prices. The regulatory hammer is the final sign that the system is broken. They are changing the rules because they lost the game. The verdict. So here's the verdict. It is over. The suppression is dead. $84 held, and the dam has broken. We are witnessing the greatest transfer of wealth in history. It is flowing from the paper assets to the hard assets, from the debt-based system to the resource-based system, from the trusting to the prepared. The move to $84 was just the warm-up. The short covering, the mother of all short squeezes, hasn't even truly begun yet. When the banks finally capitulate, when they switch from selling to buying to save their skins, the price will teleport. We will see gaps of $5, $10 in a single night. You are holding the winning lottery ticket. Do not sell it for peanuts. Do not let the volatility shake you out. The strategy: hold your physical. Do not sell for fiat. Watch the gold to silver ratio. We are waiting for 30.1, then 15.01. That is the exit signal. Ignore the noise. The media will lie to you. The banks will lie to you. The chart tells the truth. The vault is draining. The shorts are broken. The run has begun. Subscribe to the channel. We are tracking the Gamma Wall and the Shanghai Premium every single day. You need to be here when the next leg up begins. Hold the line. Class dismissed.